Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. I'm Jason McIntosh. It is Saturday, the 30th of April, 2022. As always, this is general commentary and doesn't take your personal situation into account. All right, with that said, let's jump over to our first chart. So what we have here, we have the S&P 500. And what a week we've been having. So over the last 7 trading days, we've had an 8% range in the S&P 500 and a 10% range in the Nasdaq. So really a lot's been going on. And last week I thought, so we were around about here last week, right here. Last week I thought maybe we're going to see a bit more upside, a bit more follow through from this rally we'd had about 4 weeks ago. I thought we may have had one more test up towards around here before potentially testing lower in maybe May or June. But the market just cut right through this support that it was sitting on. So let's jump over to the hourly chart, because hourlies are good for getting a little bit more definition of the price action through the day. So yeah, so let's look at it from here. So what we had last week, we had the market was sitting on this support through here, and it also picked up the Fibonacci zone. So the Fibonacci retracements we had sitting in around here. So it was around, if a market's going to bounce, that's where it would typically bounce on. It would bounce off support and bounce around the Fibonacci. So of course there's no guarantee that that's going to happen, but that's when you're playing odds, you're playing probabilities. That's your base case. You've got to go off, will the market bounce? And that wasn't the case. It cut through. So as soon as it cut through, it changed the game. Now, some people were quick to point out that I was wrong and that we didn't get a bounce. And you see it in the comments. It's like, oh look, you're wrong. But that's okay, because these videos aren't about calling every move or having a crystal ball. It's all about identifying the possibilities and then having the strategies to manage them. And I want to go back to, let's quickly duck back to the daily chart. Let me just clean that up and go to the daily chart, because it's important to keep everything in context. So if you've been watching these videos for a while, you'll know that we've been talking about this possibility here. This has been probably the base case possibility, in that I think we're correcting this whole move from the COVID lows, from the low up to the high. And I've been saying I think it's going to take time, and we're looking for a big consolidation or corrective range, something within this box, I'm thinking. And we've been talking about the possibility of this being the long-awaited 20% correction in the S&P 500. So measure that out, 20%. Yeah, there you go. It's about to the bottom of that range. So I think it's possible that we're going to see the S&P 500 actually get this 20% correction at some time over the months ahead. And so we should expect, I think we've got to expect that the price action within this band, it's going to be inconsistent and it's going to be frustrating. A lot of people are going to find this period which we're currently in really frustrating, because the market just doesn't have that consistency to it. Think of it like this. It's a bit like trying to navigate a boat up a shallow river which is full of rocky outcrops. It's hard. It's really hard to do. So, and that's what corrective periods are all about. They lack the consistency of a trending market. So while these corrective periods are difficult, it's also important to remember that they're a completely normal part of the cycle. And the aim of all this, it's really to come out the other side with most of your capital intact. And that's what I'm here to help with. That's what these videos are designed for. So where things stand, whilst the market is here, so this is where we are at the US close on Friday close in the US. We're trading right down here on our lows. And while we remain below these moving averages, I think we've got to remain defensive. And I think we've got to be prepared for the possibility of further weakness over the weeks ahead. So let's just go back to the hourly chart for a moment. We'll get rid of that big blue shaded area. There we go, get rid of that. And so what we have at the moment, we've got the market again sitting on some support. So the support comes in somewhere around here. It takes in these lows from a few weeks back. The test low we had on, I think that was Wednesday, Thursday in the US. We closed back down on support now. So we do have that support zone which the market is currently on. And we could also say that it is interesting. So let's just put the Fibonacci retracements just on this leg lower that we had last week. And you can see that rebound that we had, I think that would have been Wednesday, Thursday in the US. It came back to just inside into the Fibonacci range. So it was a case of, at the moment, it's the rallies are being sold. So we still have that distributive type price action going on in the S&P 500. And so look, that's why it looks like this has further to run. On a short-term basis, though, I think we could be nearing some sort of point where we do get a bounce. Maybe it coincides with this support level. Maybe it comes in a bit lower. Because what I want to show you is, so this is the number of S&P 500 stocks which are below their 20-day moving average. And you might remember we looked at this a few weeks ago when the market was after that big 12% rally. And we said that, look, the market is probably going to top up here and pull back. I think we're looking for a pullback of around 5%. Well, we got the 5% plus some. But it was all around, there were so many stocks above their 20-day moving averages that it was at the point where the market was overbought and needed that technical pullback. And this has been one of the sharpest technical pullbacks we've had, because now we've almost cycled back down into the oversold camp. So at the moment, there's just 11% of S&P 500 stocks above their 20-day moving average. So put another way, 89%, almost 90% are below their 20-day moving average. As you can see, it doesn't happen that often, and when it does happen, it doesn't stay that way for very long. This was a COVID crash in here. It stayed locked down there for a few weeks. But often gets down here and then we get a bounce. So that's why I say short term we could get some sort of a near-term bounce approaching, but we're below those moving averages. So I think the name of the game at the moment is play very much defensively. And it's what we'll do now, let's go over and have a look at the Nasdaq, because that's a really important part of this as well. So the Nasdaq remains weak. There's no two ways about it. We talked about last week that whilst it was below those moving averages, the 50 and the 100 day, we spoke about how it remained vulnerable, and you can see why that was. We got that sell-off. That was all part of being vulnerable. When a market's vulnerable, it is more prone to negative surprises or just negative sentiment. The path of least resistance becomes to the downside. And last week I did mention there was a potential head and shoulders pattern forming in there, like the shoulder there, the head there. This was a potential shoulder here. So that gave us that possibility that maybe the market was going to have one more tilt higher before then rolling over and having a retest of these lows. But as we spoke about the S&P 500, we didn't get that retest. We just got the accelerated retest of these lows from back in March. What's been a stabilizing factor, a relative stabilizing factor for the Nasdaq has been some of those big mega cap stocks like Apple, Microsoft, and Google. And you take those out of this index, and it would be a whole lot lower. We'll get to that in a moment, but let's just have a quick look at these stocks. So let's start with Apple. And what we see here is that Apple's been quite. It's been relatively strong. It's been one of the strongest stocks in the S&P 500, tracking within this sideways range. What's important for Apple is that we've got a support zone somewhere around, just in around here. We've got a support zone around about that 150 mark. So it's really important for Apple to really hold the line here and not break down. Moving averages appear like they could be rolling over, and it is actually below the moving averages at the moment. So the vulnerability, I think, for Apple is that it does crack below this support, and that brings more weakness into both the Nasdaq and the S&P 500. Like this pattern on its own, like these sideways patterns, they often do resolve to the upside, but it's hard to see that happening with the global state of markets. It does appear more likely that Apple will roll over. That we do see something like that, and that is of course going to be a big drag on the overall market, and that's sort of where we see the markets continue to decline. Microsoft is important to look at as well, another one of those big cap stocks. And what we have in Microsoft, it seems to be losing its footing. So we've got support around this region here, around about that 270, 275 region, and each time it tests, it's just testing a little bit lower. I think we're in a situation where we're going to see Microsoft lose its footing. I think we're going to see some lower levels here. It's it's not set up in a situation where I don't think it's going to have a rapid fall away, but it does look like lower levels are in the makings. And just quickly jumping over to Google, and what we see with Google is it's already lost its footing. We talked about Microsoft looking like it could be losing its footing just this week. This week we've seen Google crack below this support level. Moving averages now clearly lower. It's at the point of vulnerability. So it's certainly not the time to be buying the dip in Google at this point. It's one to sit back and watch. If I own Google, I'd be exiting. If I didn't, I'd be sitting on the sidelines, and I want to see how this all plays out, because it does have implications for the overall market. Internally, the Nasdaq, there's been a lot of damage done, and we've spoken about this previously, and the damage has all been done in unprofitable tech. So I'll show you. We looked at this. Oh, look, it might have been around about 4 weeks ago. ARK Innovation ETF. It's this was a boom stock. It was the poster stock for tech during the COVID boom. It was up. It went from 31 up to 157, so huge gains. But look at the unraveling we've had. I think last time we spoke about it, maybe around this period here. Downtrend was well and truly entrenched, and it's continued to peel away. So this is down 70% from its highs now. So when you look at the Nasdaq, many of the Nasdaq stocks are actually down over 60%. So it's a full-on bear market in the Nasdaq. Doesn't appear so on the surface because of those big tech stocks. It looks like a moderate correction. Pretty much. Look, you'd still call it a moderate-ish correction. Very much moderate so far in the S&P 500. But when you go down into the breadth of the market, you're seeing that there's been a lot of havoc which has been wreaked upon some of these non-profitable tech companies, and so the money flow continues to be out. It continues to be leaving unprofitable tech and going elsewhere. So people who have been buying the dip all the way through here. So we keep talking about that. The time to buy the dip is over here. You want to buy the dip when the market's above the moving averages and you get these pullbacks. You get these pullbacks to the moving averages in an uptrend, buy the dip then. Once those moving averages are turned lower and the price is below the moving average, it's sell the rallies. The game changes. A lot of people don't realise that. They just keep fixated on buy the dip. Buying the dip through here has been an absolute disaster, particularly if they don't have an exit strategy. So there could be some terrific buys here at some point, but I'm just not interested in trying to pick a low. Because at some point when this bottoms, it could grind sideways for months before it does start to turn higher. So I think tech is is a story for 2020, particularly that unprofitable tech. That story is now past, and we're moving on to, as this cycle turns, there'll probably be new leaders, there'll be new opportunities, and I don't think it's going to be in this space again anytime soon. But we'll watch the price action and judge accordingly. Now, going over to the Russell 2000, I want to touch on this again. We spoke about this, I think, a couple of weeks ago. The issue we had a couple of weeks back was that the market had bumped its head up against this big resistance band. This had been support during much of 2021. Broke below here. As soon as we broke below, that became resistance, and it's tried a couple of times now and failed. And we were talking about and saying, well, this was actually a bit of a warning for the overall market, because it was hard to see the overall market being able to rally, like the S&P 500 rallying, when you've got this big cross-section of middle America stocks trending lower, below their moving averages and below resistance at the point of vulnerability. And now we've had, just in the last week, we've broken to a new low. So it's down over 20%, so it's in bear market territory. And I think the big thing which is weighing on sentiment is there are now 10 rate hikes priced into the US interest rate system. So I think this is just going to take time. It is going to continue to take time. This is going to need to base at some point and then slowly start to turn higher. But we're not even at the point where we can start looking for a base, because we have a downtrend. We do have a downtrend at the moment. The market path of least resistance is lower. It could start to find some sort of short-term base, because it does look oversold, as we're looking at with those number of S&P 500 stocks below their 20-day moving average. There could be some sort of we could get a near-term bounce, but the path of least resistance is still for lower levels. I think that's what we need to expect. And as I've been saying, this part of the cycle, this is a part that frustrates just about everyone, and just about everyone gives back profit. The winners through these periods are the ones who come out the other side with much of their capital intact, and with not mentally beaten up, and that they're ready to take on the new entry signals when they occur. So it's not about buying the dip here and getting yourself into an emotional state because you don't know where to get out, or market keeps slipping. Forget all that. Exit the stocks that need to be exited, and protect your capital, and then good times will return. We just need to wait. No one knows how long that's going to be, but that's how I'm playing the game. And look, if you're getting value out of this, please hit that like button, and please leave a short comment. Just let Google know that you're getting some value from it. Just, hey, thanks, like the video. Something really simple, tells YouTube people are engaging, and then YouTube will put it in front of more people, and hopefully more people watch, and I'll keep making more videos. So that would really help if you could please do that. Let's jump across to, if you're wondering why I'm doing a Saturday edition of Trade the Trend, it's because I had internet issues yesterday and I couldn't access TradingView. So without TradingView, there are no charts, and no charts, there's no videos. So we've got a special Saturday edition this week. So over to the ASX 200, the Aussie market. It continues to be one of the strongest markets in the developed world. And we've had this sharp move lower from this resistance band. So we've now got a triple top. We'll now call this a triple top resistance. Don't get too many triple tops. And I had thought maybe we'd come back and I thought maybe we'd consolidate sideways below for a little bit and then maybe punch higher. But that hasn't been the case. The weakness has been there's been more weakness than I was initially anticipating. So I think, look, at the moment, I think the best case is that we do go into some sort of a sideways range. Could see it pull back further. Structurally, it still looks constructive, but I think the likelihood is that any chance of a break higher is well and truly delayed. There's just too much weakness now with these breakdowns we're seeing in stocks like Google, Microsoft teetering on the edge, Apple looking wobbly. It looks like this global weakness it's going to continue to be an ongoing theme, and it's hard to see the ASX 200 breaking higher against that. And I lost one of the stocks in my portfolio. I lost one of my best performing stocks last week, and I'll show you. It's just a good indication of like how I'm playing this this whole consolidated period we're getting. So this is my trading software. So this is a stock called Universal Biosensors. And so I got into this stock back in, when was this? Back in July 2020. Moving averages had crossed. We had a breakout to a 70-day high. It's been running in my portfolio ever since. You'll see the red line below. That's the initial stop loss. Then you've got the trailing stop loss. I give them lots of room to move. And the reason I give them lots of room to move is because we always get these pullbacks. Markets and stocks, they always have these pullbacks. And these are significant pullbacks. That could be, I can't measure that out, but that's probably around a 25% pullback, possibly even a touch more. So if I had a close trailing stop, I would have been cut out here, or here, or here. But I give it lots of room to move, so I stay on this big trend. And this is also a stock from my Motion Trader subscription service. So I'd have a lot of members who would have been buying at the same time, running the same trailing stop, because I use the same trailing stop as my Motion Trader subscription service. Stayed in this for ages. Through this whole consolidation, the wide trailing stop has kept me in. It started to tighten up recently, and it gets to the point where it's the trailing stop. It's like my line in the sand. It's like, well, okay, I've given you lots of room to move. You'd now come back and hit the trailing stop. I'm out. So I sold this stock. I think it was a gain of 180% thereabouts. So, not a bad result for 18 months. Moving averages are now turning lower. It's now vulnerable. Maybe it bottoms here and bounces back, but the risk is that it doesn't. The risk is that it continues to do this and fall away. And I've got to tell you, I've seen so many people hold on to stocks like this, and then over the course of a year or so, they give back all their gains. It just happens so often. So that's why the exit strategy is so important, and that's why I use these wide trailing stops. And so my stops are automatically calculated. I use an algorithm through my Motion Trader system to automatically calculate the trailing stops. I'm using average trading ranges as a key component to the calculation. So that's how this trailing stop line is determined. And it's interesting. Most people have probably never heard of Universal Biosensors. I know I certainly hadn't when I got the signal. And that's the great thing about algorithms. They not only tell you when to get out, they also find these stocks like this, which few people have heard of. So yeah, look, that's great. It's 180% gain. It's now locked and in cash, and all due to having these algorithmic scans that can go through the markets, find these opportunities. We're finding the stocks to look at, and then we're finding the stocks to avoid after they've turned lower. And if you're interested, you can grab a quick 2-week trial. I'll leave a link in the comment section of this video. I'd love you to come across and have a look, see what I'm doing. And okay, so with that said, let's go over to gold, because gold has been interesting, as it often is. So where are we? Let's scroll down. I find my commodities section, and that is not it. See, this is a problem when you have so many things you're watching. Here we go, gold. Now, gold, we're at a key level. We're really now at a key level in gold. So this is this support band through here that we've been watching over the last few weeks. Structurally, it still looks okay, but it really needs to hold this support level. It's also picking up the 100-day moving average at the moment. If this level breaks, the alternate scenario, which we've spoken about a few times, is a retest down here of these lows. So it's I'm just drawing the bearish scenario. So it's not the preferred case at this point, but let's just be aware of we'll reacquaint ourselves, because we've spoken about this before. If this support were to break, I think it would bring in some unwinding of gold positions that were built up after the breakout. So after this breakout here, this was the invasion of Ukraine. It all started. We had a lot of new interest in gold, a lot of buying. We've had part of that pullback, but there's still a lot of new positions which are still in gold. So the risk is that if it does break down here, those positions start to unwind, and we do see gold sort of make its way back down here. We could get a market that looks like that. Still not my preferred case. I think we've got to go with the breakout, and the market is above support, so we need to give that the benefit of the doubt. Doesn't mean that that's going to work out in our favour, but we've got to give that. I think the play is to give that the benefit of the doubt until proven otherwise. But look, just so you know, that's what I think the alternate situation is. But look, I think longer term, I think the longer term chart structure looks really good for gold still. I just haven't changed my view on that at all. So I'm just going to quickly show you a weekly chart. I'm going to put it on log scale, so it just picks up these longer term movements a bit better. I have a bit more data. Yeah, I think it's just loading up a bit more data. So there we go. So what I'm thinking, I can't really compress it anymore. What I'm thinking is that I wonder how. Let me just quickly check this on a monthly scale. Look, that will work for giving us an idea. So we get the whole price movement back in from going back to 1975. Overall, this is a long-term uptrend, and whether the gold market from where we are now, if we pull back to back down here and retest those lows, in the scheme of things, it's not a big deal. Let me just do that again. It was a bit messy. If the market were to pull back down here, it's not a big deal in the scheme of this bigger picture trend. It could come back. It could spend a few months going sideways, and then it could start to make its way higher from there. So I think the overall pattern is bullish. We just don't know the pathway that gold is going to take. So let's go back to that daily chart, get the log scale back off. So look, we just don't know the pathway. Is the pathway higher? And look, maybe the pathway isn't higher, but that is the longer term trend. We don't know whether it's going to be from here and up, or whether it's going to be up but via a retest. Time will tell. Just looking at some of the stocks, if we just have a quick look at Newmont. Newmont has had a great run since the beginning of the year. We've come back to the moving averages. We put the Fibonacci retracements on of that move, and you see that's just come back to the top of the Fibonacci zone. What we've seen so far is completely normal within a bull market. So if you wanted to buy the dip in gold or in Newmont, this is where you'd consider buying the dip. Where it's trading above its 100-day moving average. That's the time to buy a dip, not when the price is down here falling away from its moving averages, but when it comes back to it. That's the time to buy the dip. So at the moment, Newmont's still holding in there. And then you look at GDX, which is the gold mining ETF, and a quick look at that. We're broken out from this pattern. We've had an initial run. We're getting the return move. Again, this is completely normal stuff. We're back at those moving averages, and let's just check the Fibonacci's. We're right in that Fibonacci pocket. If it's going to base around here, this is where I think you'd expect it to base. Look, so all that said, I think gold. I think it's important to note that gold has done well in the backdrop of this US dollar move we've been seeing. We haven't spoken about the US dollar for a while, but let me just find the US dollar here and look at this. This is fascinating, really. So this is on a daily chart. Look at this strength we've had in the US dollar since the beginning of the year, and we're now going parabolic. It's both the yen and the euro are falling away rapidly, which is giving rise to the US dollar. And now I'm going to put this on a weekly chart to show you this big range we're broken out from. So look at this. This is this trading range the US dollar's been in for around five or 6 years, and we're broken to the top side of it. So that's a really significant thing. But even though that's happened, you look at gold, and gold's holding together really well. Gold normally struggles when the US dollar rises. So we've had this massive rise in the dollar, yet gold is holding the line quite well. So I think overall that's structurally bullish for gold. So Look, I think overall, if you want to buy the dip, this is a point where you can do so. You can manage risk with a relatively tight stop loss. We've been through one of those scenarios which could see us wash out. But look, overall, I think the near-term direction of these gold stocks, it all hinges on what gold does, here and now with this support. So let's watch this closely. I think it's going to be a really interesting time for gold coming up in the next few weeks. So look, let's leave it there. Thank you for joining me. It's been fun talking to you again, and look forward to coming back, and let's try and put it all together next week. Thank you.